Welcome back to the delivery hall. So this session, Lessons from an Angel, is about what really happens when capital is personal. Angel investors sit in a different place to funds, they move faster, they live much closer to the founder's reality, and their mistakes are harder to hide in portfolio theory. So the question today is, what have our panelists actually learned from backing companies with their own money, about timing, conviction, governance, exits, and what do they wish founders and VCs understood better about that role and what's going on in that universe. So Ash is going to moderate this for us today, and we'll make the introductions from there. So good luck, Ash.
Perfect. Thank you. Thanks, Roderick. Welcome, everyone. Back-to-back day today, and what a beautiful venue. VC is obviously the content of the day, but what leads to VC? Angel. And so we're going to talk about a bit of a blend of those subjects on this panel today. I'm joined by Tim here, I'm joined by Serena here, and by John as well. We're waiting on our fourth. She might turn up halfway through the panel, and then we'll do an intro then. But for now, just the three of us gives us a little bit more time. I'll introduce myself quickly. My name is Ash Phillips. I'm an occasional investor. I've built ecosystems for startups over the last 15 years. We have loads of deal flow, and I need places to send it. So it's a great place for me to be today. But obviously I'm moderating. We want to know our guests a little bit better. So in this order, let's start with you, Tim. A little bit of an intro on who you are and what you do, and then we'll dive into the questions.
Yeah. Thanks, Ash. And hello, everyone. Yeah, I'm Tim Mills. I'm managing partner of ACF Investors. We are a UK fund, purely UK-focused, investing at seed, Series A, and beyond, but always investing alongside angels. So our general hypothesis is angels add a huge amount of value to companies in the early stage, particularly when they have subject matter expertise. We work alongside those individuals through our diligence process initially and to support the companies as they grow and scale. And we've been running this fund for 15 years now, invested in 130 odd companies. That's the hypothesis we started out with, and 15 years down the track, we're absolutely doubled down on it. Getting the right investors, angel investors in at the beginning is absolutely transformational for businesses when you get it right, I must stress.
Love that. Great experience to share, and we'll dive into that in a second. Jean, over to you. I'd love your intro.
Cool. Well, it's nice to be here. And also it's nice to get my name in Europe as Jean. In the US, I go by Gene. Sometimes I actually haven't corrected people on my name, so they still call me Gene after knowing me for many years. I used to be a physician, so I used to be a surgeon not too far away from here. And then I ended up accidentally just doing research to build a company. So yeah, didn't really know what venture or angels were back then, but ended up raising venture capital. Anyway, that company we grew and ended up selling to one of the big US companies, Medtronic, and it was a pretty significant exit for a UK healthcare company. And then I guess I became an angel because I was investing. When I became an angel, I kind of was like a cash machine for entrepreneurs, because all the venture guys told me that, if you like people, then invest in them. So my barrier to entry was, if I understood what you were doing and I liked you, then I'd make an investment. That's changed now, so no one connect with me anymore. But yeah, after exiting the business, just made a bunch of investments. I think over 30 plus angel investments.
I love that. I think we're going to learn some lessons from those today. I'm glad you added that caveat, because I was worried we were going to have a line of people with gifts for you to try and get that investment. And then last but not least, let's come to you for the final intro.
Yep. Hi, everyone. My name is Serena. And I guess I have a few different hats. From an angel perspective, I've always grown up with my father being an angel investor for the last 20 plus years, and he's always involved me in that as well. So it's been quite like a natural transition into me also then going into the family business and building up my own kind of investment thesis within our family. But I've also seen his thesis change throughout the last 20 plus years, and how his thinking around being an angel has evolved as well. And I have a lot of entrepreneurial friends as well who have been angels but not really called themselves that. So when I started building it myself, they were like, this is a word, like this is just what you do for friends. And kind of coming into the London scene, joined a few networks and built that out, and then started working in VC as well. So have a few different kind of angles from that perspective.
A real breadth of information. So we should dive into the questions to get some of that information out, right? The first question I've got here is about angel portfolios. I think you alluded to it, Jean, around how people invest in people they like. Sometimes that leads to angel portfolios underperforming, and that's probably leading to people stopping angel investing, which is a shame. How do we stop that happening? What's going on there? And if you have halted or changed, in your case, Jean, what's changed for you over those years of 15 years of experience and 130 deals? This is a question to all of you. How do we create portfolios that perform and continue to invest and not stop?
Yeah, I think, certainly if you look at when we started out with the fund back in 2011, putting it together, we deliberately set out to be sector agnostic. We were locked to the stage by the size of tickets we were running, which were up to $1 million. But we thought we'd see where the market led us, where the UK opportunity led us. And it did lead to us having a skewed portfolio in those first few years, skewed to healthcare and life sciences. There are a lot of great early stage healthcare and life sciences businesses coming out of UK universities and hospitals and other areas, so that it's quite easy to find those as an angel. What we discovered is it's much harder to find follow-on VC funding for those companies. So we make fewer of those investments today. But I think to the nub of your question, I think if you're coming afresh to angel investing, the best advice you can give anybody is just be eyes wide open. You need to build a portfolio, and you need to be conscious with every investment you make how that adds or detracts from the portfolio, and diversity in terms of spread of sectors to a stage, if you can do so, geography, but also over time is important to get the long-term return. So yeah, that's what I would say.
Interesting. There are a bunch of sub-questions I'd love to follow on, but just keen on your thoughts if you guys have been investing, angel investing, VC investing, of course, but angel is the topic of the panel. What's kept you going throughout those deals, and have you ever thought about quitting? And if you have, why did you stop?
I think you really need to evaluate, like, why are you angel investing? Is it truly like an investment strategy for you, or like you started, people you knew, friends, etc. I think the mentality is very different, and I feel like a lot of people are coming into angel investing now as kind of like, almost like they see themselves as fund managers, or it's like a really core part of how they see themselves growing their wealth. And then my thinking is always maybe go a couple steps back and educate yourself on what it actually is, and think about what your motivations are, because it is a long-term strategy. You're putting your capital at risk, etc., all the standard things. But yeah, really evaluating your motivations.
Just for clarification, I never invested in friends. I think that's the worst thing to do, because then you have to have conversations with friends about how they do. I'd rather just talk about life with friends. I think, you guys are way more serious than I was. I never really spent time thinking about portfolio construction. I just was like, you're working on something cool, that's great. I understand it. And I think you're hardworking, and you don't look like you have a criminal record. And I never really did that background check, though. I don't know if you can do that as an angel investor. But basically, I had a set of parameters. So if I found someone who was technically competent working on something they really were passionate about, so much so that they were willing to commit their energy, their life, their own capital, they'd had real commitment to what they were trying to fix, then I always looked at it as it's going to be a 0 or something. If it's a 0, have I helped this person try and do something that's their life mission? That's okay. If it goes to 0, whatever, I've helped that person. If it's something, then obviously it's great. That's kind of like the philosophy back then.
Yeah, I love the slightly tongue-in-cheek criminal record comment there. There's a rhetorical point I'll make about the investability of the people on the Forbes 30 under 30, but we won't go there. The question I do want to go slightly off-piste on, so apologies for taking you around the mountain here a little bit, but there was an embedded piece in that first question around the performance of angel portfolios. You don't have to give me literal numbers, of course, but I'm curious if they have done well, any of the deals that you've done. What were the differentiators between those people that did do well and the ones that didn't? What did you spot in them or miss in some cases?
Yeah, I mean, getting the data on the performance of angels is difficult. The only sort of or really serious piece of academic research is a report which was put together, probably about 15, 16 years ago, which is called Siding with the Angels. It's mainly data from the noughties. And the number it produced at the end of it was an IRR, I think, of 22%. There was massive survivor bias, massive bias in terms of the level of reporting, but it was a number that was carried forward that good angels can return 22% as an IRR. And I think, it's interesting, so 15 years on from reading that report for the first time, the pattern that you see over and over again is people that take it seriously, commit to it, look at funding strategies, build portfolios, invest in things that they understand, or at least alongside people that understand them, are the ones that succeed. Those that approach it in a more casual manner tend to be the ones that have underperforming portfolios. And that number, that IRR then was stated as being an arithmetic mean. The mode for performance of most angels was to lose money, certainly before any tax reliefs. So I don't think it's changed that much.
So although I might sound casual, I had been an operator of a business, right? So, the one thing in VC that a lot of money managers in Europe don't have is like real operating experience, no offense, right? And building a business is incredibly challenging, right? It is, we sold our business and we did like very well, but there was not a day which I found easy, right? And I'm building another business right now. The challenge is big, right? So what I would say is, just in terms of addition to your point, our portfolio is doing well. It's now kind of in a process with a fund, and someone I've known for a long time who's actually a friend, is the fund manager. And we've raised some external capital, and so we have, Qubit as a venture fund. But, one of the things that, I think is really missing in Europe, and it's started to change because I've seen lots of people set up operator-based funds, but is true operating experience, right? And so when I made investments in people, again, it may sound casual, but the ability to understand whether or not you believe somebody has all of the skill sets to be able to fundamentally operate a business, that was just an inherent thing that I would look for. I wouldn't be able to categorize it, but I can tell you, is this person going to have a bad day and wake up the next day with a smile on their face and go back to work, right? Is this person going to go to a sales meeting and be told that their product is shit and still smile and politely take feedback, right? Is this person going to be able to deal with, employees, and all the issues that you have with employees, right? Is this person going to motivate people, right? Find people who are, in incredibly safe roles and convince them to leave those safe roles and take a bet on them and join them on that journey, right? So there's inherent things that, we would look for. Hard to describe, but, I'm describing them now, but there you go.
Yeah, I would just add that I think it's hard to predict anything. Every year, each company looks different from the other. So the ones that we've actually had decent exits from 3 years ago, we probably thought that they were weeks away from bankruptcy. So it's hard to predict, and it's hard to choose the winners, which is, for example, in VC, why a lot of people are now saying we shouldn't have a follow-on or reserve strategy, right? For the same reason. As an angel and as a VC, it's really hard to pick the winners. And the business will look different from day to day. We've had some interesting exits. We have a decent portfolio, but also we've had a lot of failures as well, of course. Yeah.
We were always weeks away from bankruptcy. So
I feel like if you weren't, then your investors would probably be pushing you harder to spend that money, right? It's that burn rate calculation. Serena, I want to stick with you just for this question here. Jean mentioned the operator angels and investors. The ecosystem's growing and diversifying all the time. We're seeing scout models, venture scout models. We're seeing solo GPs and the rise of those. You've got exposure both to the angel space and the VC space through that family setup. Curious where you think it makes it difficult for founders to find their feet, right? Where that blurred line can be a little bit confusing for people. What have you seen, and does it hurt founders having that really diverse and growing ecosystem of players?
Quite a complex question. I think it's great that there's more people and more complex ecosystem because it means there's more players, there's more people that we can access, and as a result of that, there's more opportunities for example, I invest a lot in female founders. That's my own kind of thesis from the family and with the VC fund Borski as well. So I think it's great that we have a more diverse and bigger playing field, but obviously it still makes it difficult when people are relying on warm introductions and then trying to get into a space. I find that a lot of founders don't even really understand what VC is. And then I keep always hearing how do we get into the family office space, and just the basic education on capital and what is available out there to start and run a business, I think is quite lacking across the board. But I also think the ecosystems are very different across Europe. So I'm from Finland. My family business is in Finland. We've done mainly stuff in the Nordics and Baltics, but I live here. I've been here for 18 years, and I'm primarily investing now here as well. But then the fund is in the Netherlands, and all of these different ecosystems are wildly different. And then US, for example, is even more different, just in terms of people's appetite to risk and stuff as well, but also the capital available and how people move. So what was the question? How are people navigating the space? With great difficulty, I think, but I think education about what types of capital is out there would benefit a lot of people.
We're also not touching on the socioeconomic elements and the accidental nepotism, if not forceful, that comes into play here as well. But that's a whole other panel, so we'll get to that another day. Jean, I want to come to you if you have any further thoughts on that question. But also, you mentioned that operational element. How do you enact that with your portfolio? Do you get hands-on? Do you dive in? You said you're building another business right now. I'm assuming you're short on time. So what does that really look like, and what can people do if they're doing that in themselves?
Cool. I was sitting here just thinking there was one thing someone once told me as a US VC, and I just came back from the US. So, but he was just like, Europe is just like a museum, dude. And then we're just sitting here with the museum.
The irony.
So, I don't come from a background of, any specific value, to be honest with you. My parents are just hardworking people. I had to work hard for everything. I had to, get into medical school, which was, the happiest day for my mum. And then I had to tell her I had to leave medical school, and I made her cry. She's like, what are you going to do with your life? It's like, this ventures, I've got a venture investor. But, I think there's a lot of words in the ecosystem: angel investing, family office, whatever. What we used to just think about is how do we fund this and where do we get money, right? And, a lot of people used to say no, right? They still do. So, again, it just comes down to the tenacity. There's someone just once described me in a very complimentary way as like a dog with a bone. So I felt that's very complimentary. But this tenacity is this ability to continue to do something, irrespective of 25, 30, 100 people just say no. They punch you in the face and they're like, this is such a awful, or they send you a really polite email. Love what you're doing, but it's not for us right now. Or this is not right stage. So I just think there's a lot of deep psychological, like soul searching, right? And so I find like my job as an angel and now as an investor is just basically to be some sort of therapist, right? You know, and I think people, you know, all of us now think of therapy as like seeing a therapist, but I actually think like the greatest therapy in life is your family, your friends, your community, the people that you mentor you, right? And so half the time I just spend my time just like listening to people having a bad day and then just saying like, it's okay, like I've been there, right? And you just got to keep going, right?
I mentioned motivations for, as angels should evaluate their motivations. I think the same thing applies to founders. What is it you want to build? And then, like, for example, if you don't want to build fast and at scale, maybe VC is not right for you. Yeah.
I'm just going to come to you, Tim, for a specific question here around syndicates. And, you know, and then this will open up actually to the rest of the panel, but do you think that, you know, the solo angel approach versus the syndicate angel approach, do you think that it's kind of shone lights on the specific problems or the specific mistakes that solo angels make? When you've got 30 of you in a round together, you can spot problems or challenges or do better DD. What do you think the pros and cons are for that syndication model?
I guess, you know, starting with the, I'm hugely biased, right? Because we only invest in syndicated deals. We absolutely believe that's the only way to back early stage venture. The reasons for that are, borne out by bitter experience along the way. It's a long journey. Companies face lots of problems. As an investor, you have a life to lead outside of the investment you're making. To be a useful investor and lead an investment as a solo investor is very challenging indeed. The advantage of syndication is, of course, at the point of diligence, you've got, you know, within the syndicate, hopefully a depth of knowledge and expertise, but also cognitive diversity. You know, to Jean's point, one of the things that is distinctly lacking, certainly in many institutionally led rounds, is operator experience. In the angel community, is made up principally of people with deep operating experience. What we look for is people with deep sector focus and market focus, and I think, you know, there's certainly a truism with most UK companies that they are brilliant at technology. We've never backed a company that's failed because they couldn't build a product, because they couldn't get the technology to work. We've backed a good number of companies that have failed because they've built a product and they couldn't find enough people to buy it. And so we're very focused on, when we look at those syndicates on a holistic basis, it's finding people that can help companies find that product market fit and find it quickly and iterate and adapt to deliver. Because, you know, most companies say the technology is rarely the problem, but you just tend to run out of cash before you manage to get to enough.
So beyond that, just to add to that then, for everybody, very briefly, because I'm aware of time also, is what do we think about the democratization of access via, you know, SPVs and syndication platforms, Odin, Valbin, etc.? Do we think that's net good or net bad for the ecosystem and the founders? Is it making, you know, a plethora of dumb money, or does it enable more people to get into the ecosystem and more money as a result? What do we think?
Net good, okay. I think.
Appreciate it.
Because it allows people to get into it. It's like an early stepping stone. But and I'm all for syndicates and SPVs and small tickets. We will do that. But I'm also very much, I don't invest in through syndicates. But again, for me, that comes down to, again, motivation. Why are you like investing? Do you want to outsource decision making to someone else? Then fine. If you just want to have a little bit of access and understanding of the market, it's a great way in. But if you want to be more involved and your point of view is maybe even a bit more strategic, then maybe you don't do that.
I usually like to make a binary decision about something, but I'm kind of on this point. I have I think syndication is good, but the reason we set up Qubit and the reason we have a team now that runs the process is because, there is a game that people can play, right? Which is they turn up and they're like, oh, this person's investing, this person's investing, this person. Sometimes someone's turned up and I'm on the slide already, right? I'm like, oh, it's cool. And then you're like, this is great. And then you're like, who's done the work, right? And so Theranos, I mean, no one did the work, right? That's like, what happened? No one did the work, right? So this syndication stuff is great and naming people and then being like this, but the issue that the thing that I always try and like figure out now, if we're not leading and doing the work, and we now always did the work, the team always does the work, Max and Pelc, but if we haven't done the work, back then I wish I'd asked like who's actually done the work, and can I understand what their thesis is and what are they taking to IC and how they underwrite, like all the questions that are now, sophisticated questions that you'd ask, right? How would you, do the work, right? So I think someone has to do the work if the syndication's going to work.
I feel like you've already covered your answer there as well previously, Tim. So I'm going to bring us towards a close right now. We may have time to open up for a question, or two. But my final question here really is probably a question everybody here has got, which is, what is the one piece of advice that you would give to someone angel investing for the first time? Actually, do a little bit of audience participation. Who's angel invested at some point in this room? Okay. Who wants to do some angel investing or proactively looking to? Cool. I know people are like shy there, because just in case there's a founder here.
I can tell people are shy because I know at least like a handful that are angel investors in
just
this
kind
room.
of, we saw the hands, that's the important thing. And so for those people that are thinking about it, or maybe future investors via these syndication models, etc., what's the piece of advice that you would give to them, or ultimately to your old self?
Yeah, pretty simple. If you're thinking about it, it's the first time, just pause, do your research, go along to some angel groups, look at stuff online, talk to people, just do your diligence and give it time. I mean, it is a cliche, but it's something we see a pattern repeat over and over again, which is somebody, whether they've quit a big job, whether they've sold a company, they come into the market with some money to invest, and they have a focus, and often it's a sector that they're really interested in, not necessarily a sector they know very much about, and they meet a bunch of great founders who've got compelling stories, and so many of them are great people, and they write a bunch of checks, and then reflect on it afterwards. If you're in that position, just pause and think, can I partner with somebody who's done this before? Can I join a group where I can share other people's expertise? Approach it as you would a true business problem, rather than, as I say, in the lighter way that some people do. Because, it's an exciting space to be, and we all get tempted by exciting ideas and exciting founders. So, putting that break in your system, I think, is the best thing.
I agree, but also disagree. I think I see a lot of people get stuck in too much, like trying to figure out what is it we're doing and getting into it too deep. Sometimes just make sure that they don't have a criminal record, like you said, and you want to invest in it, you're relatively interested in it, just write a small check. Networks like Alma Angels and other small syndicates will allow you to get in with smaller checks. Do like 5, 10 tiny tickets, join some other experienced angels, and just get started, because you're going to learn more from actually doing it than you can ever do from initial research, in my opinion.
Love it.
Yeah, so I think you guys have given very good advice. I'm very gung-ho, so I used to just write tickets. And I tend to make decisions very quickly. I think if you're writing small tickets, like whatever, 25, whatever it is, just like, make decisions fast. I think on the other side, what I would just say in terms of, the people that, sorry, let me just add to that. Figure out who's doing the work, right? So if there's a VC that's leading this, then just make sure that you know who that is and they're reputable and they're doing the work, right? So I think that's definitely very important. And I didn't really understand how important this was, because we always raised capital from great people, like from top VCs, tier A VCs, so I always imagined that everyone else was doing the same. So I would make sure, one, that people do the work. On the other side, just from a founder's perspective, right, I think just like, don't lead people on. Right, I think that's the worst thing to do to someone, right? Whether it's, in the context of life or, founders, just don't lead people on, because I think it's just, not a good use of their time to run around chasing you. So sometimes the best thing you can do for someone is just say, no, this doesn't work. This is not for me. And be quick at doing that, because then they do all this work, they make all these spreadsheets you ask for and everything else. You're taking something away from that person, and that opportunity cost isn't nice to be on the receiving end of.
100%. I will add to that, and that's a perfect segue to the tip that I guess I developed while I was initially part of the angel program with Ada Ventures, invested 50K across 5 deals, tiny little checks, but for someone who's working class like me, it was the first step into that ecosystem like you mentioned, John. And one of the things that I experienced was, from the founder point of view, is wanting a quick no. How do you give somebody a quick no? When also you might not have a legitimate operational reason to say no. It just doesn't feel right. And I realized that the honesty about that is just really, really key. The narrative that I gave people, which was the true narrative, is essentially, if I'm not talking about this or telling my friends about this 48 hours later, doesn't mean it's a bad company. It's probably just that I'm not the right person to invest in it. And it was just a much easier way for me to get back to somebody very quickly. Look, we were never going to solve angel investing within, under an hour. But hopefully we've made it a little bit easier for everybody else in the room to understand, attack that space, and do some good deals and get involved through these syndicate programs or independently on your own. I don't know if we've got any time for any questions. We don't, but we're all here in the room. We can always ask independently. Thank you so much for joining us, and a big round of applause to our panel.